All right, let's talk about Pfizer. You know, the pharma giant. They're at this massive crossroads right now. So the big question is this a smart buy or a stock you should stay far, far away from? We're going to find out, and we're going to do it using a legendary investment framework. Let's get into it. And here's the real mystery, right? The stock is trading near a 10-year low. I mean, wow. So is this some kind of hidden bargain, a golden opportunity just waiting for us? Or is it a classic value trap? You know, something that looks cheap, but is actually cheap for very good reason. That is exactly what we're here to figure out. So how are we going to crack this case? Well, we're going to use Warren Buffett's legendary 4-point inspection. Seriously, think of this as our detective kit for investing. It's got 4 simple steps. First, we look at the business itself, then the management. After that, we crunch the financials, and finally, we figure out the value. It's a simple, but man, is it a powerful way to get to the truth.
Okay, let's kick things off with step 1, the business. Now, Buffett is famous for loving companies that have a strong moat, you know, like a castle. It's just a durable competitive advantage that keeps all the rivals at bay. So the big question for Pfizer is, just how strong are its defenses right now?
You know, Buffett's very first test is super simple. Do I actually understand this business? And with Pfizer, yeah, the answer's a pretty clear yes. I mean, at its core, their model hasn't changed in decades. They develop medicines, and they sell them. It's consistent, it's easy to wrap your head around. So that's a big checkmark for Buffett right there.
Okay, but here's where things start to get a little tricky. In the past, Pfizer's moat was like Fort Knox. It was built on these ironclad drug patents and the simple fact that, doctors don't really like to switch patients off a medicine that's working. But the threats today? They're serious. There's this thing called a patent cliff looming, which basically means their biggest money-making drugs are about to face a flood of cheap generic competition. And if that wasn't enough, you've got all this rising political pressure on drug prices. Suddenly, that fortress moat, it's starting to look a little leaky.
And look, this isn't just our take on it. The experts over at Morningstar literally just downgraded Pfizer's moat rating from wide all the way down to narrow. So what does that tell you? It tells you that this fortress, the one that used to seem completely impenetrable, is definitely showing some serious cracks. And for a Buffett-style analysis, that's a major red flag.
All right, so with the shaky moat, that leads us right into our second checkpoint, the management. The business is under pressure, so what are the folks in the corner office doing about it? Where's the money going? Where are they placing their big bets?
Okay, so take a look at where Pfizer's profits are going. This is pretty wild. Over 99%, almost all of it, is being paid out to shareholders as dividends. Now, don't get me wrong, investors love a good dividend, but that leaves basically nothing, less than 1%, for reinvesting back into the business to grow it from the inside. And that's a massive trade-off, right? Because it means they have very little cash to fund internal innovation and fight off that very same patent cliff we were just talking about.
So, you gotta ask, if they're not reinvesting their profits to grow, what's the plan? Well, the plan is to buy growth. Management is betting the farm on acquisitions, with a goal of adding a whopping $25 billion in revenue from buying new companies, like the big Seagen deal by 2030. Now look, it's a logical strategy to try and plug that hole from the expiring patents, but it's also super risky. Trying to mash huge companies together is always a headache, and there's absolutely no guarantee these big bets are going to pay off.
Okay, so we've looked at the business and the management's big bets. Now it's time to get into the nitty-gritty, the financials. This is step 3, our financial health check. We're going to give Pfizer a report card and see exactly how it stacks up against some of Buffett's key benchmarks.
And the report card is, well, it's mixed, and that's being generous. On the plus side, their debt-to-equity ratio is satisfactory, which is good. But then you look at return on equity, needs improvement, and earnings growth, failing. Yikes. Both of these are way below what Buffett would look for in a so-called wonderful company. That failing grade on growth is especially tough to see.
Yeah, let's zoom in on that return on equity, or ROE, for a second, because it's a really key weakness. Just think of ROE as a grade on how well the company is using shareholder money to make more money. It's all about efficiency. And Pfizer's grade, 10.6%, is well below the 15% plus that Buffett really likes to see. It's a pretty clear sign the business just isn't as profitable as it could be.
But wait, it's not all bad news on the financial front. There is a definite bright spot here. The company is an absolute cash-generating machine. We're talking $14.3 billion in free cash flow. Now that is crucial because it means that massive dividend we talked about, it's safe, it's covered, at least for now. This cash flow provides a real bedrock of stability, even with all those other weaknesses.
And all of that brings us to our final, and you could argue, most important step, the value. After looking at all these challenges, the shrinking moat, the risky strategy, the mixed financials, what is this company actually worth? This is where we hunt for Buffett's holy grail, the margin of safety.
Okay, so we're talking about intrinsic value. It's a fancy term, but all it really means is what a business is truly worth, totally separate from its day-to-day, bouncing all over the place stock price. Think of it as the company's real price tag. And this, my friends, is where the story gets really, really interesting, because a whole bunch of analysts believe Pfizer's real price tag is way, way higher than its stock price today.
Okay, let's look at the estimates. First up, we've got Simply Wall Street. They're pegging Pfizer's fair value at a massive $62.11 a share. Now, remember, the stock is trading around 25 bucks. That is just a huge potential upside.
All right, now, let's get a second opinion, a more conservative one. Valueinvesting.io puts the fair value at $32.03. So, not as high for sure, but still, that's a pretty healthy premium over where the stock is trading right now.
And for our third estimate, Alpha Spread comes in at about $29.56. Are you seeing the pattern here? The numbers are all different, but every single one of these valuation models is pointing in the exact same direction.
And this slide really drives the whole point home. You've got the current stock price sitting around $25, but the fair value estimates, they're somewhere between $29 and $62. That gap between the price and the value, that is the margin of safety, and it's a big one. This is exactly the kind of situation that gets a value investor like Buffett excited, the chance to buy a dollar for 50 cents, so to speak.
So we've looked at the business, we've looked at the management, we've crunched the numbers, and we've sized up the value. We've put all the pieces on the board. Now it's time to put it all together and figure out the final verdict.
And really, this whole analysis can be boiled down to one single powerful phrase, a classic Buffettism actually. This looks like a fair company at a wonderful price. And notice the order there. It's not a wonderful company at a fair price, it's the other way around, and that makes all the difference.
So let's break that down. What does that really mean? Well, the problem is that Pfizer, as it stands today, is not what you'd call a wonderful business. We saw it, right? The moat is narrowing, and the financials are, frankly, subpar. But the opportunity is that the market sees all this, and it has absolutely hammered the stock price, creating what looks like a wonderful price. You get a huge margin of safety. This all leads to the final recommendation, which is hold. Basically, the price is incredibly tempting, but the quality of the business just isn't quite good enough to scream buy.
And that really leaves us with the big final question, doesn't it? It's the core dilemma that every single value investor has to face. Is a deep, deep discount worth the risk when you're buying a less than wonderful company? Is that huge margin of safety enough to protect you from the very real challenges the business is up against? The answer to that question? Well, that's what investing is all about.